Hey everybody, good afternoon. Has anybody talked this much in 3 days? My voice is going hoarse, but I'll try to make it through our last day here. But great conference. I can't believe how many great conversations I'm just overhearing. But glad to come and talk a little bit about industrial real estate. And the title, Demystifying It, is, we talked about that because there's a lot of folks who say, look, I'm in a couple of these asset classes. I don't really understand how to get in here. So hopefully all of you leave here today with a little bit of extra knowledge. You feel like you understand a little bit more and feel comfortable maybe pursuing some investments in the space. So, let's see if this ticker works. There we go. My name is Drew Wahlgren, head of capital markets here at Magna Capital Partners here. So we've acquired over $550 million in assets since 2015, and those are primarily industrial. So this is our focus. These properties you see in these photos, these are properties we own and manage currently. As I say, this is the sexiest real estate. Rooftop pools, trendy lounges. Not exactly, but the tenants pay rents. There's exceptional demand now, and we're going to talk about that today. So. Oh, this is a tough button. I got to push hard. So let's talk a little bit about history of industrial, how it's fared. Last 10 years, right? Look at the chart here. This is just transaction volume, right? So you see it coming up from 2011 to today. Nice big bump in 2015. I showed this to someone and said, what is that? There wasn't actually anything, in the market that popped that up in 2015. I looked back and found some pretty large institutional portfolio transactions, so that can have a huge uptick there on the entire transaction volume there. But you get to 2019 and things are accelerating, and 2020 obviously will drop there. Again, a lot of the institutions, they drive a lot of this asset class and that transaction volume. They pulled back, right? Everyone's wanted to put their feet on the ground during COVID to see where they landed. We actually took that as an opportunity. We closed on about 8 properties in that summer, and really found our opportunity as institutions pulled back. We were able to slide in. So it's good to be nimble out there. I know there's a lot of nimble operators. But here we are in 2021, record-shattering year as far as transaction volume goes. So since COVID-19, let's go look at more recent history here. This chart's showing cap rates. So the purple line here, I believe that's secondary markets. Yeah, the light gray line there is primary markets. So you see things compressing, kind of flattening out 2017 to 2019, and then boom, COVID happens and the cap rates go subterranean, right? Let's look at this chart. Just again, recent history here. This is year over year asking rents in industrial real estate since January 6th. Look at the markets. Anything sticking out to you here? I mean, Inland Empire, hot, very hot. We're going to talk more about that. Miami, probably the hottest. I think they had something like 15 to 16% rent growth in a year in industrial. Obviously, New Jersey, a lot of the ports, right? This is industrial. There's a lot of demand around inbound ports. So, Long Beach and LA, a lot of that has already it's infill, right? Where are you going to find a space to develop another 1 million square feet of warehousing, right? And so they've started to move east, and that's why you see that exceptional demand, and we're going to show more about that in the Inland Empire. So you see that in some of these other markets as well. But Chicagoland, of course, this is I think the center, really, the #1 area for logistics in the country. So why is that? The rise in e-commerce, I almost hate talking about this. Everyone knows what's happening. We all participated in it, right? Especially over COVID, you're ordering things online, right? But you can't talk about industrial real estate without talking about this. It's a key part of it. Really, industrial real estate and the demand there has really been pivoting directly with brick and mortar retail. So everyone knows the story here. I won't spend too much time, but as retailers have bolstered their supply chains, they need more, they have a hub and spoke model, right? So they need to fill out these hub and spoke systems to be able to deliver product quickly and on time. And as you know, got to keep up with the Amazons, Walmarts. They'll deliver to you in 1 or 2 days. So you need to have a robust system. I should go back to that there. I like that CBRE quote. For every $1 billion in growth in e-commerce, you need another 1.25 million square feet of industrial. Anyone here think e-commerce is going away? So another thing I want to talk about that doesn't get enough light is the renaissance of American manufacturing. There's a lot of reasons for this, but I had a couple quotes I put in here. So even from 2010 to 2020, we're seeing more onshoring of manufacturing. You see more and more jobs. It's kind of hard to believe, right? I mean, it's nice to see as an American. You go, cool, we're bringing a lot of that back. It was kind of sad a little bit when we saw a lot of those jobs go away and communities being hurt. So very cool. It's coming back. And since the pandemic, as you see here, when they looked at distribution centers, warehouses, and manufacturing plants, they found that out of that mix, the manufacturing facilities, they soared 93% year over year. So what's driving it? Risk mitigation. You have companies saying, look, we have supply chains that have exceptional amount of risk, right? If my supply chain starts on the other side of the world, there's a lot of risk there. There's natural disasters. There's shipping risk, right? I'm going to show you some photos for fun later of that, but there's more risk there. And as I read one particular quote, a guy said, a guy owned a series of factories, and he was moving them from China to Mexico. And he said, a shorter supply chain is a stronger supply chain. So that kind of resonated with me. Self-reliance, right? We don't want to be dependent on other countries and facilities outside of our control to bring us pharmaceuticals we need, essentials, right? How about masks, right? I mean, that's just one example. So military defense, this already exists here, frankly. There's too much security risk to offshore military defense manufacturing, right? But consumer sentiment, people are drawn to this, and Walmart's made a commitment to buy more goods and foods that are made in America and processed here. Sustainability, too, as companies start to get a little more aware of what their footprint is on the environment, right? They're going, look, there's shipping pollution, and then there's manufacturing pollution in other countries. Do you think that they're doing it as cleanly in China as they're doing here? No, they don't have the same regulations, right? You want to manufacture something in here, you have to be compliant with the laws, which prohibit you from grossly polluting, right? Transportation costs and time, I talked a little bit about that, but here are the photos. Everyone's seen that as we've seen supply chain issues, right? All the ships out at sea, they're waiting to come in. Well, it would have been a lot better if you had a manufacturing plant in North America. Even if it's not in America, maybe it's in Mexico, as I said. They're developing a huge amount of manufacturing plants in Juarez right now because of that issue that we're having. And there's probably a little slimmer risk, but you see a ship, once in a while one has a little issue and they drop off a few containers. So that's something that you're going to take on as a risk if you're a manufacturer that wants to set up systems overseas. So let's talk about what we're talking about here. Industrial real estate, I think people sort of immediately go to warehouses and distribution centers, right? We all think of last mile delivery centers and all the infrastructure that Amazon builds to get you those goods in a day or two. But there's a lot of other types, right? Flex industrial, I put a photo here just so people can kind of identify that. This is in everyone's backyard, right? They're kind of hidden. You see there's no signage. It's pretty common. It's not someone's storefront. This might be service industry like a plumber. This might be a small manufacturer where they store parts and equipment. It might be something along that line. And these are multi-tenanted properties a lot of times. And if you like to manage multi-tenanted properties, as a lot of people here do, they're great, right? And really the trade-off there between a single-tenant property and a multi-tenant property in industrial is really you have a lot of smaller operators in these kind of spaces, right? Are you going to have a robust credit profile behind that tenant? Probably not as much as someone who's leasing out 500,000 square feet, who might be doing hundreds of millions of dollars in revenue versus Joe Plumber, right? Someone who's got a small business in a community. So cold storage, that's out there. There's a ton of demand for it. There's always been a supply-demand imbalance out there, but the cost of construction is very high. Heavy manufacturing, I put a photo here so you can kind of identify what we're talking about. This is a lot of, think chemical manufacturing. That's what this looks like here. I pulled this image from Google, but certainly looks like something there. And I would certainly say that just if anyone's looking at something like that, we steer clear as an investment firm from properties like that because they're special use. So if you want to use leverage, you're not going to get more than about 50% because the lender is going to consider that special use. So it doesn't mean that it's not a good investment. Maybe you have a quality tenant and you believe in, but you take on, you got to figure that out in your underwriting, right? So research and development, that's kind of laboratories and things like that. Industrial showroom, this particular photo, we actually looked at acquiring. It's in Ohio, called, anyone from Ohio here? All right. Well, I think they're called Watsons, right? furniture and sort of outdoor furniture seller and distributor. So they have a showroom in the front. It looks like retail. You walk in, you can see the pools in that photo there. You see, hey, you can come back here. And in the back, of course, they have the warehouse. So they're able to load up the trucks and deliver that to your front door. So we want to talk about risks. What kind of risks are you going to take on if you get into industrial? I mean, number one for us, since we, Magna Capital Partners, we focus on single tenant industrial, it's credit risk. A single tenant, my rent's binary. I need to know how strong this tenant is. So if you're looking at, I mean, there's different credit profiles, right? You have investment grade, lower credit, as you can see on this bond rating chart, and private credit. Investment grade tenants, this is what I think a lot of people are thinking of when they think of industrial, right? Hey, that Amazon warehouse, that's investment grade, right? It's about as good as you can get. So what kind of yields are you going to get out of that? Not much, right? But you can look at non-investment grade, and it doesn't mean that that's a garbage tenant. They could be very strong. You have to sort of dig in and find out. But for a lot of folks, they don't want to dig in that much, and they want to look at something like this. Look, it's a known quantity as far as a credit risk if you're looking at, you know, an investment grade tenant. Hey, they're AA. Walmart, I think, is AA, right? But this is a very important piece, and I would highly suggest you focus on this heavily. And you know, it's uncommon for a lot of real estate men and women to turn from real estate to corporate credit analysis, but it's a key part of this investment. So again, if you're looking at this property, how concentrated is the tenant base? Again, we talked about flex. Look, I got a 5-year lease with the plumbing company. Okay, I've found out they've been around for 10 years, and they don't have a whole complex debt structure behind them. And look, I have 20 tenants in this property. I'm going to do some light due diligence there. Same thing with a multifamily property, right? People are running credit reports, but there's a lot there unknown, but it's okay. You're diversified. So risks, I jotted down a bunch here. This goes so much deeper than just these elements. I mean, these are just some very basics here, but that you'd want to look at, customer concentrations for them. Hey, is this customer serving, I'll give you an example, actually. I looked at a property, and the company that was occupying the property was manufacturing these robotic arm assembly lines for Ford, right? Really cool stuff. This stuff's not going away. It's a way of the future, robotic welding, spot welding, all that stuff. But it turned out 80% of their revenue was coming from Ford. Would you invest in that? We didn't. We said, no, that's a house of cards that potentially looking to fall. So what I would suggest is bring an expert. Bring in credit analysts, whether it's on your team or on a transactional basis. I put in this logo, Risk Advisory Partners. We've focused so much here that we've actually hired a whole credit team. We brought them in from the institutions, and they created an entity to actually serve other investment groups and other investors as they look to analyze credit, because they don't have that background, but they like an investment, and they want that, well, what I kind of refer to as an insurance policy, right? I want to know where all the risk is coming around this tenant. So if you're interested in this kind of stuff and want to talk to me later, I can plug you in with rap. I told them they need a good song to pick to go with their commercial sometime. The lease structure, this is a great one. All kinds of lease structures out there. It's more common in industrial that you'll find triple net leases. This is a lot of what we do at Magna Capital Partners, is single tenant net leased properties. And there's different forms of that, right? Gross lease, there's all forms, and it's a big spectrum here of what a landlord's responsible for and what a tenant is. Every shade of gray in between, but gross lease being, hey, you're responsible for everything as a landlord, and absolute really is on the other end of that, where the tenant's virtually responsible for everything. That's a great investment, right? Sit back, go hang out on the beach, hammer that check every month, right? So triple net, though, may not include all those things. So it's important to know that and really to understand the lease and what you're responsible for as a landlord. You may say triple net, and I think the misconception is that is everything. A lot of triple net leases don't include roof and structure. Got a 500,000 square feet, guess how much that roof might cost, right? HVAC systems, paving the parking lot, a lot of that won't be included. So you will have some reserves to build into your underwriting if you have some of that responsibility, right? So what about the lease guarantor? Now, there's a lot of nuance around this. It's my favorite thing to look at and talk with brokers about. Who's the parent company? Who's the entity? Is this a portfolio of properties? Maybe they have separate entities for 3 different properties, and they're all owned by a parent entity. Who's guaranteeing this lease? Each individual one? Well, okay. Maybe one of these goes BK on an individual basis, right? Bankrupt, right? So I would like to have that parent company as a guarantor. And I'm also going to talk about the leases here. As you see, the master lease or cross-defaulted lease, a lot of nuance there too, depending on what type of organizational structure this tenant may have. But a cross-defaulted lease basically allows me to say, look, if you default on one, you default on all three in that example. So you might want that as well as a parent guarantee, corporate parent level guarantee. So that organizational structure, again, those entities, it's really important. And I'm sure everyone here who's investing has a great legal team. I would highly suggest working very closely with a legal team when you're negotiating a lease like this. It's very important. It actually drives a lot of the value in your property, right? Hey, I signed a 15-year lease with this tenant, isn't that great? Well, then you try to sell it and someone looks at it and goes, oof, this is risky. They don't have the right guarantees in place. So, good thing to know about that. Let's talk about that Chapter 11, right? A multi-tenanted property, multi-property portfolio is what I meant there. And we have a few of these in our portfolio. And you want to know that what you're holding is important to this company if they have multiple properties. And even if you're investing in one, do they operate 7 others? So where does your property fit into their corporate structure? There's Joe's manufacturing facility, and you own a warehouse where they store overflow goods before they're shipped out. And they file Chapter 11. For those of you who don't know, under Chapter 11 bankruptcy, you can restructure, you can write off debts, and you can restructure your leases. You're not immune to that. They have to move out, of course. So you want to know that in a Chapter 11 bankruptcy, is this tenant going to stay? Do I have the crown jewel of their portfolio of properties and operations? Is it a profit center? This is really important stuff. So I have a couple examples here. Circle K, and remember back in 1990, I was a little bit younger, but I used to go to it when I was a kid. These guys, they had this corporate guarantee on their lease, and so investors who own these properties, and Circle K had a preference for leasing properties, Circle K filed Chapter 11 in 1990, and the investors who own these properties figured, I have a corporate guarantee, I'm in great shape. Well, they didn't have site-level profitability. They didn't know that they were actually the owner of a site of Circle K's that was an absolute dog. So what happened? Of course, they filed Chapter 11. They broke those leases under protection of the court. So those investors were in a bad shape. They didn't realize that they were holding, fat. And they cut out that fat as soon as they filed Chapter 11. Another one, Kmart. In 2000, Kmart was an investment-grade tenant, Baa3, I think. So that's considered investment grade. So these guys in 2000, you go, hey, I'm an investor, I own a Kmart. Pff, good times, sit back, it's triple net. Again, you're on the beach with the margarita, right? Well, 2 years later, they filed Chapter 11. And what they didn't do with their landlords is in their lease structure, they didn't share financials. So this is another something that you'll want to have. I want my lease to require some sharing of financials throughout the hold because I bought in 2000 this property. I have a 15-year lease, but I didn't know over the next 2 years these guys were suffering. They're probably losing market share to Walmart. So that's really important, and all those investors really learned that lesson the hard way because when they filed Chapter 11, they closed 300 stores. So last point there, I talked about the site level and corporate level. It's good to have both. We require quarterly financial reporting from all of our tenants. And not only is it important for you to mitigate your risk, it's going to be important for the person you sell to. I know for a fact that every institution out there who buys a property with an existing lease will not buy it if there's no financial reporting. So you may be saying, hey, everything's going great so far, and I'm going to sell this thing for a nice profit, and your broker takes it to market, and Store Capital or Veritz, one of these big dogs, comes over and goes, no thanks. We're not going to invest in this. There's too much risk. I don't understand how well the tenant is doing today or in 5 years from now. If this thing craps out on me, I'm sorry. Come on. Okay, environmental risk. I'm going to breeze through this quickly just because, in interest of time, but my recommendation to anyone investing in this space needs to have an environmental consultant. No one here is an environmental expert, I don't think. If you are, then maybe you should be plugging in with some of the industrial investors here, because you may find a wreck on there. A REC is not a recommendation. It's REC, Recognized Environmental Concern. So I'm sure you guys are pulling phase ones on a lot of other properties. There just happens to be a lot more risk in the industrial space. Manufacturers, right? And they are using solvents. Well, they used to back in the 60s and 70s, and some of that bleeds into the groundwater. Everyone understands there's risk there. So there are ways to build around that risk. And you may find an opportunity because the institution said, oh, there's a REC here. Not for us. You may look at it and say, look, we are able, again, with the help of environmental consultants, get indemnity for your lender, for instance. Get indemnity for yourself. Maybe the seller, if you're doing maybe a sale leaseback, or maybe not a sale leaseback, and someone is a third-party seller here, they have it, and you may be able to leave the risk on their plate. That might be difficult, but these are options. Ways you can box out that risk and find some pretty great yield. If I go over time today, I'm going to blame it on this. Come on. There we go. Oh, did I skip a couple? Well, I wanted some examples to pull up here. So I just took these directly from an email from a broker. These are just some. I just wanted you to kind of say, hey, what are we talking about here? Industrial. Here's a small property, right? $3.6 million are asking for, 6% cap rate, Corpus Christi, right? Not exactly border town, so but it's somewhat close to the border there. But you can see this is a very Class A building, recent construction there. And I'm sorry how small the writing is here, but this is tilt wall construction, it looks like. Very nice stuff, very popular these days because of very high clear heights, and nice storage. There's a tenant in place. So you might say, here's a good example, right? It says, 9 years remaining on this lease with Marco Group International, a part of Already LLC. Okay, there's my tenant entity, there's a corporate entity. That's my first question to the broker. Who's guaranteeing the lease? Is Already guaranteeing it? Let me see their financials. How strong are they? Let's move on to another one here. This one I've seen floating around for a while, so if anyone's, you might be able to drive the price down on this thing. I think they're struggling for buyers on this thing. Rosenberg, Texas. It's a flex industrial. It's kind of a funky shaped building. I would certainly be asking to see more of this building. What's on the inside? Did they subdivide it? Anytime someone says flex, you don't really know what's going on the inside. It's just kind of, you know, they might have subdivided that up a little bit. So it's vacant here. So sure, it's $54 a square foot, which is great. Replacement cost for industrials anywhere from $150 to $200. For the really Class A stuff, you're talking about $250 to $300 for, you know, again, 40-foot clear height, tilt wall construction, that really beautiful stuff, you know, what Tesla builds for their manufacturing site. So, you know, it's trading at a discount because it's vacant. This might be a good lease-up play. Come on. Maybe I broke it by pushing too hard. North Chesterton, this one actually caught my eye. I've sent this to a couple folks who like industrial. I said, hey, check this out. A little too small for us, 1.3 million bucks. But it's right on the Indiana side of that Chicagoland market. But as you can see, a 5-year sale leaseback. Oh, okay, now you have the ability as an investor to structure that lease. And by the way, that's what they're asking for. Maybe you get them to 10, maybe 15. Right? So you can negotiate those on a sale leaseback. This is something we focus a lot on sale leaseback. So you're able to negotiate and maybe say, hey, let's drive the price down, but I'm going to lower your rent. Keep the cap rate the same. 8% cap rate. That sounds pretty good to you guys, right? Sounds good to me. But here, look, triple net lease. Landlord responsible for roof structure and HVAC. So keep that in mind. At least they put it out front and let you know, right? And forget those little ones. Let's look at a big one. Let's look at Class A. Let's look at where the institutional money is going. This is why folks like yourselves, I would assume, and folks like us, we don't invest where the institutions go because they drive these cap rates subterranean again. This, and I'll tell you after I talk about this where this one traded at, but Ontario, California, I redacted a little information. I don't think I signed any CA here, but tire distribution site, right? Credit tenants, Ontario, California, Inland Empire. Remember I showed you the map earlier? It's hot. Well, it's, you know, this is very Class A stuff, 30-foot clear height. But here's the play. Look, in-place rent 42 cents per square foot, triple net. Market's at 69, and the lease is up in 2023. Okay, maybe you will come in for a low cap rate and say, look, I stand to bring these guys up to market, or even find a new tenant because vacancy rate, I'm going to show you in a minute, is extremely low in the Inland Empire. Anyone like this deal? Raise your hand. All right, I like it. Institutional guys out here. So just going to give you a little data. I'll go through it. I wanted to give you something up to date here, at least up to Q4 of 2021. This is just total inventory, right? So Chicagoland, again, the center of logistics, right? So that's how much existing inventory, not unleased, just total inventory. So Chicago's a monster. Year over year rent change by market. Look at the bottom there. Inland Empire, I'm telling you, it's hot. It's very hot. So because of that, that's why you might see that that last deal I showed you with the tire distribution center. Hey, there is a reason they're behind market because the market has moved so much. And how about this? Industrial vacancy by market. Also, number one, Inland Empire, 0.6%. I feel pretty good about that tire distribution center if they decide not to renew the lease, right? I got 800,000 square feet. Well, I'm pretty much the only game in town, right? You want industrial warehousing in the Inland Empire, you're probably the only thing available to someone who needs quite a bit of it. So some closing remarks here. Industrial's been a great place to be. You've seen it. We showed some data here. We're going to continue to invest in this space because we see continued pressure and the supply-demand imbalance, right? So e-commerce, again, we have to talk about that when you talk about industrial as an entire asset class. But really going forward, there's this direct relationship with brick and mortar retail, and that's why industrial has skyrocketed in demand, right? Brick and mortar retail just went the other direction, right? In COVID, in 2020, I should say, and beyond. And how much that recovers, that's the question, right? So if you're asking yourself, should I invest in this space? I kind of ask yourself, hey, do you think that we're going to go backwards in e-commerce, right? Are we going to have less e-commerce in the future? I think most people wouldn't agree with that. But how much is brick and mortar retail going to come back? And I think what we're seeing out there is that they're slowing down some developments from some of these large investment grade type of companies who are building out those hub and spoke models. They've done quite a bit there in the last couple of years. But as people return, they're slowing down. I think they're gauging the market a bit before they start taking on new development projects and working with investors like yourself to develop new warehouses. So that's the question. Does anyone think e-commerce is going away? Of course not. So I think when you look at that, there's a lot of downward pressure. Even if you have a flex facility, a manufacturing facility, something that doesn't fit that mold that people think of, that Home Depot, credit tenants, distribution warehouse, there's an overall pressure on this asset class to buy more because of that supply-demand imbalance. And I would say we're going to see some strength for years to come. We don't plan on shifting our strategy anytime soon. So thank you so much, you guys. I appreciate the time, and I know everyone's hungry for lunch, so I appreciate you sticking around. If you want to talk more about industrial, I'll be out there eating lunch. Come join me, and thank you again.